Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for this segment, we have Brian Joyce, Managing Director on Nasdaq's Market Intelligence Desk, for an update to watch in the Nasdaq 100 Index. Brian, it's great to see you as always. Welcome back to TradeTalks. And I think the question everyone's trying to answer is, will other parts of the market catch up with the performance that we've seen in the tech sector, because really breadth continues to be weak here?
Yes, we have seen some weak breadth. We know the top 6 or 7 largest mega cap stocks, especially in the Nasdaq 100, have been driving a lot of the outperformance, not just in the Nasdaq 100, but also the S&P 500. So it's certainly, a valid point that market participants are making. My bias, though, however, is it looks like we really could be on the potential here for some rotation into, other companies within, say, tech and communications, which are 2 leading sectors this year, and then potentially into other areas of the market as well.
Yeah, well, that's a good point that you make, because I believe those 6-7 names that are moving the Nasdaq 100, I believe they make up like 23 to 25% of the S&P 500. So as goes those names, goes the market. It's not specific just to the Nasdaq 100. Granted, the weighting is higher within that index.
Sure.
But when we think about it from other areas of the market, small cap as an example, that's been down all year, but the cost of capital higher in them, a little bit unable to invest in their businesses and grow, that environment's not going to change anytime soon.
Sure. Absolutely. And if anything, we could see rates go higher.
Right.
So maybe we don't see a rate hike at this June meeting, but there's talk, potentially further out that maybe we do see more rate hikes. And if that's going to happen, that would be on the back of persistent inflation, and I would expect continued economic growth. So we'll try to anticipate when that recession is coming. The long awaited recession that everyone here is sitting around and just waiting to happen. And, there's plenty of arguments to be made that, due to particularly employment doing well, construction payrolls, still holding up very well, that maybe that recession, if it's coming, is maybe a lot further off into the future, late 23, early 24. And if so, then, what will the marketplace be doing between now and then? So those small caps, those micro caps, those charts don't look well. If you look at the Russell 2000, the Russell micro cap, they're trading right around the low end of their range. And, the concern there is that we'll see a breakdown below that support that's been in place for many months now. But there's some areas of the marketplace, particularly the larger caps. We know what's been doing well, mega cap tech, some consumer discretionary, autos are doing well. But can we now see a rotation into other things like industrials?
So let's take a look at a couple of your charts here. Look at some fresh levels to watch on the Nasdaq 100, and then we'll also discuss where you are seeing, or potentially could see some momentum in the market.
Yeah, so right now, we've had a very nice run year to date. We're over 33% in the Nasdaq 100. The weekly RSI is over 71 here, almost 72. This week's, candlestick pattern, we'll see how we finish, by the close tomorrow. You could argue at the way it looks now, it looks a little toppy. And if that were the case, it wouldn't be the end-all be-all. We could see potentially, a consolidation that's in a relative sideways range, and that wouldn't be an unhealthy thing to happen. What I would highlight about the Nasdaq 100 is if you really zoom out on the longer-term basis and you look at it from a monthly period chart, the momentum MACD indicator, moving average convergence divergence, it's making a bullish crossover its signal line this month in June. We're in the first day, and it's making that cross today. And so from this deep negative level that we have seen this since mid-early 2022, we haven't seen that happen really since the lows of 09 and the lows of the .com bursting of that bubble. So it took about 3 or 4 months after the lows of those indices were made during those 2 significant market declines for the MACD monthly period to cross over in a bullish way. We're just now seeing that in the Nasdaq 100. So you could make the argument that maybe we're actually not towards the end of this cycle. Maybe from this index's perspective, maybe we maybe the lows are in. Potentially, if we have some headwinds in the future and the economy and the fundamentals get weaker, but maybe the lows are actually in, and the pullback will be relatively modest on that time frame. But the 3 main sectors within technology, we have I should say the Nasdaq 100 tech, which makes up 50%. That's had a nice run. Communications, that's had a nice breakout. And the next biggest sector is the consumer discretionary, makes over 15% of the index, and this is yet to really make a breakout. So you could argue that this group looks pretty ripe from here to make a move to the upside. And then finally, the Nasdaq 100, it's testing its 10-month resistance level. We actually had a minor breakout above it a couple of trading sessions ago, a brief pullback yesterday, and now we're moving higher today. So if this were to break out, concerns about breadth and leadership just amongst the top mega caps, while this is an equal weighted index, you would certainly see an improvement in breadth if we see a breakout carried by that upside momentum.
Right, and then from a macro perspective, in June, we're really just looking at economic data, what the Fed's doing. I mean, we're kind of out of the earnings rush here. We don't get anything until like the third week in July.
Yeah, and the recent volatility we saw in the marketplace in the month of May, the dollar was moving higher off of recent lows tested, initially made earlier in January. We retested them in April and May, but we were moving higher throughout most of May, and that typically is associated with a brief risk-off period or risk-off period during the dollar strengthening, and we're now seeing today, that reversing lower. It's only really a one-day move, but we saw inflation data come out of Europe, and on the headline numbers, it was better than expected, but I don't think it's anything, from if you zoom out and kind of look at the big picture, I think they still have an inflation problem, so they may be, not as far along. They certainly, I don't think, are far along in their rate hike cycle as we are, so you could argue just based on that metric alone that the dollar would have some, some headwinds, can get weaker, which arguably you would say would be, a positive for a lot of these larger caps names.
Right. Well, I think it's the employment data that's being really stubborn here, and which is kind of has the Fed. I wouldn't even say pause. I mean, potentially you're looking at a couple more rate hikes. I don't think you'll see any cuts this year. I mean, they haven't signaled that whatsoever. But
sure.
When you think about inflation, is it really, at least in the near term, ever going to come down? Do you think retailers are going to adjust their prices now that people are somewhat, used to paying what we're paying? We also have shrinkflation going on, where packages are much smaller than they used to be for what you're paying.
Yeah.
I mean, you've seen it. There are some areas of the market where it feels as if it's correct. We're seeing it in automobiles right now. There's too much inventory on dealers' lots and so forth. But do you think like prices are, again, you don't have a crystal ball, but prices will ever come back to, let's say, pre-pandemic levels? Because supply chains are somewhat getting back to normal.
And that's the difference. Whether prices come down to pre-pandemic levels, right. Probably not, but inflation can stop, increasing from here. And we've actually seen headline inflation and core inflation coming down, but it's still, prices are still going up, just not as much. So that rate of price hikes, higher prices is fading. How much will it fade going forward? I think will depend on the job market, as you noted, and really I think a lot of focus is on that residential construction payrolls. That's holding up well. It seems to be a good indicator as to, a good timing indicator for when maybe recession is going to, set in. And so right now I don't think we're seeing, any signs that is, reversing.
But I mean, even housing costs, right? There's no inventory, so prices are being elevated, rates are too high, so there's really no transactions going on. We've had a number of people in private credit and private real estate come on the show, and unanimously, every single one of them are telling you that it's the residential market. I mean, rents, no one can afford to buy, so rents are moving higher, higher, higher. It gets to a point where is anyone going to be able to afford to live on their own? So that's the whole thing too. I mean, the higher these rents go, if the employment situation comes in, I mean, that's when you start thinking about the economy from a more broad perspective, because there will be no discretionary income.
Yeah, and if the employment situation comes in, then it'll be a lot harder for some to stay in their houses.
Right.
So the employment situation now is still holding up very well. So, people who have a low mortgage, and many of us do, around that 3% level, then, they can stay in their houses for longer. They're not forced to move. They're not forced to, say, find a job elsewhere and sell their house. If and when that happens, that could then be your domino effect. So we'll just have to wait.
Let's hope we don't get there. All right, Brian, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.